So good afternoon, everyone, and welcome to today's REI webinar. I'm Neil Peterson. I'm the founder and editor-in-chief of REI, and I'll be your moderator and host for this power-packed session today. And a quick note before we begin, today's session is being recorded, so you will receive a replay link if you registered, that's of course. So please use the Q&A box for questions, and we will take the selected ones at the end of our discussion. So just a little bit about REI, those you don't know. It's been South Africa's leading independent property investment platform for 18 years. In fact, this month we celebrate our 18th celebration and serving the South African real estate industry. So we deliver daily news, magazine with inspired information, webinars, live events, our REI TV interviews, information and education insight to empower investors, house buyers, professionals, decision makers across the property ecosystem. So today's webinar is part of our ongoing weekly series, helping you to navigate property trends, data, and opportunities in the South African property market. And today's topic couldn't be more urgent: South Africa's property market pulse. We're going to look at valuations, rates, rentals, and what are the regional biases. And our focus is going to be to check in on the property market, to look at those prices, the finance and the rentals, where we stand now, and what is next. We'll unpack the latest data and outlooks from Lightstone, Betterbond, and PayProp, covering prices, lending, rentals, and investor dynamics. So, without further ado, I'd like to introduce you to our powerhouse panelist team. First of all, to Estiani Marx. She's a business development executive at Lightstone. Estiani brings deep expertise in property data and analytics, tracking pricing trends and regional dynamics. Great having you, Estiani. Would you like to shout out to the audience out there?
Awesome. Thank you, Neil. It's always a privilege to be on the webinars. And yeah, looking forward to a great discussion with panelists and also to share some data and see what's happening in the real estate market.
Absolutely. Look forward to it, and great having you on the show. Then, of course, we've got Brad Bendel. He's the sales director at Betterbond. And Brad will share live insights and trends from South Africa's largest bond originator, covering lending appetites and affordability shift. Welcome to you, Brad. Great having you on the show.
Thanks, Neil. Hello, everyone. Good afternoon. Great to be on the show, especially considering that the market conditions are looking positive. The last time I was on the show, the market conditions were somewhat dismal. So we're looking forward to sharing some of those good news points with all of you today.
Absolutely. Great having you, Brad. Awesome. We look forward to that feedback. And then last but not least, we've got Michelle Dickens. She's the commercial director at PayProp Repit. And Michelle brings the rental market lens, trends, what's happening on collections, arrears, vacancies, and basic all the yields across the provinces. Welcome to you, Michelle. Lovely having you on the show.
Wonderful. Thanks, Neil. So lovely to be here and to be sharing some of the data on what's going on in the property market at the moment with your delegates here today.
Awesome. Great. Wonderful. So without further ado, I'm going to hand you over to Estiani. Each one of our presenters are basically going to take us through a presentation and setting the scene, and then before we get into our discussion. So Estiani, I'm going to hand over to you, and I know you got some wonderful data to share with us today.
There we go. Thank you, Neil. Just double checking that you can also see the presentation properly.
Perfect. Yep. All good. Right.
All righty. So I think the importance here is for us to look at, first of all, what is happening in terms of the property value growth over the last few years. And I think long gone are the days where we had our 40 plus percentage increase in terms of inflation of property values down in 2004, 2005. But we've been tracking very flat over the last, let's say, 15 years, which is also good, not too many downfalls, unfortunately not a lot of upside, but we can see there are certain areas such as specifically the Western Cape where we had quite a lot of positive returns over the last 15 years. In many instances way above the national inflation as well. Some of the areas maybe not tracking as positively as we would have hoped. We have seen Gauteng struggling a little bit, but similar to that, there's been other areas which have also really done very well, like your Northwest, Limpopo. It's always good to understand what's happening in the smaller provinces as well in terms of property values and see how the growth looks in those provinces over the years. Then just maybe also looking at, the average sales price over the years. And as I've mentioned now, that although we haven't really seen the massive increases that we've seen back in 2004, 2005, the positive side to this is that on a year-to-year basis, the average sales price of properties are still increasing. And that is across the board. Yes, there's areas that may not be doing as well, and areas that are doing really well, but all in all together, the average sales price of properties are still increasing year on year. So very, very positive from a property sales perspective, as well as from an investor perspective as well. Then just looking at what has been happening in terms of the sales volume, so specifically for the period Jan and August on an annual basis, and we specifically looked at that time period because for 2025 we can't yet, record on full year, but we wanted to see how are we tracking as opposed to some of the other years. Now, 2020 was obviously a year where we had a dip in the number of transactions happening due to COVID, but 2021, 2022 was phenomenal years, specifically where our interest rates were quite low. I think it was the lowest in 50 years. And that certainly helped with the amount or number of properties that transacted. 2023, 2024 was quite tough. We had our interest rate increases again, 10 consecutive increases in terms of interest rates. And we also had our election years where, there was a little bit of uncertainty in terms of what's going to happen from a political point of view. And 2025 haven't really started off as high in terms of the numbers of sales that we have hoped for. And we still see a little bit of struggle in terms of the market. It has picked up though. So we're hoping to end strong for the year 2025. And that's certainly something that we are navigating quite closely and monitoring. Then just looking at our property values in terms of different price bands. So I think it's also important to understand the different markets. And here we can see that, specifically the property value growth that we have obtained in the affordable and the mid-value areas. So although, the average prices in those areas or those value band properties are lower, almost, in this instance, below R1 million per property. The value growth that we've seen there was quite phenomenal. In some instances, about 16%. Whereas obviously in your super luxury areas, the value growth wasn't as high, although also still really tracking relatively good at almost about 7% on average. And then just looking at the mix in terms of activity. So in reality, where is majority of the sales really happening if we're looking at these different market segments? And we can see that about 70% are still happening within your affordable, your mid-value and your high-value areas. So that's literally where majority of our sales are happening, about 70%. And then minority will be obviously your super luxury areas as well as the luxury market. Then just looking a little bit at your property affordability, so specifically in the bonded space, and I know Brad will, share some in-depth details with us as well. But just looking at the proportion bonded in terms of these markets that I've just spoken about, and what's quite interesting there is we could see that over the last 5 years, we've actually still seen a little bit of a decrease in terms of bonded transactions in these different segments, all except for the mid-value area. So the last year, so 2025, the mid-value segment seems to have been picking up in terms of where properties are bonded as opposed to being acquired from a cash sale. So that's quite interesting to see and to see how that navigates through to the rest of the year. Then I think it's also important to understand, in terms of the price or the bonded space in terms of the age group, so the demographics and who are primarily taking out loans as opposed to having cash transactions. And there we can see our younger generation, so 18 to 35, almost 80% of the transactions for that age group have been bonded, where our 65 years and plus our pensioners, typically, if there are any purchases, it will be cash. There's been only about 6% that have actually been bonded. So that is what we're currently tracking. And we can also see, obviously, our 36 to 49-year-old market, that's where majority of our buyers are sitting. So majority buyers buying in that age group, and about 70% of those transactions have been bonded. And then just looking at understanding the markets a little bit better to understand how long properties are actually sitting on the market, and also what is the price point that's being obtained for the properties in the different provinces. There we can see that on average at the moment, properties will be sitting on the market for about 90 days before it sells off. Some areas a little bit less, some areas a little bit more, but on average sitting on about 90 days. And what's quite interesting there is that areas such as your Western Cape and Mpumalanga are obviously some of the lower time that it actually sits on the market, but also obtaining quite a higher percentage in terms of the asking price. So that's quite good to see. And again, speaking to the importance of understanding the value of properties and pricing the properties right. Then just having a quick glance again at the immigration, so understanding in terms of immigration for the Western Cape specifically in this instance, so we can see that in our country at the moment, it's only the Western Cape that has a net influx if we look at the immigration figures, and then also understanding, where these immigrators are coming from. And obviously majority will be immigrating from Gauteng. Second to that, KwaZulu-Natal, and third most would be your immigrators from the Eastern Cape moving towards the Western Cape area. So that's me, Neil.
Great. Yeah. Wonderful. Thanks for setting that scene, Esiani. We're going to go, there will be a lot of questions, I'm sure, as we move on, and we will delve into it a little bit deeper. So, Brad, I'm going to hand over to you. I know you don't have slides. You want to talk us through it. That's all good. And so maybe you can tell us what's happening in terms of lending trends, approvals, affordabilities, etc.
Yeah, thanks, Neil. So, as I said previously, the market conditions are really looking good at the moment. The net effect of the 6 interest rate reductions are starting to take effect. Unfortunately, we still have this massive problem of very high household debt ratio. So, and that's a product of the low interest rate, ironically, of the low interest rate during COVID, where people purchased homes at 7% or 7.5% and have effectively had a 67% increase in interest rate to 11.75. We're now sitting at 10.5. So that bodes well for the future. And as people would know, there's a MPC meeting tomorrow. So we're really holding thumbs that they see the need for a further interest rate reduction. We're not confident that that's going to happen, but we are forever hopeful. Just in terms of trends that we're seeing in the market, the average purchase price is now at 1.6 million, which is a record. Average first-time home buyers, the average price is 1.3 million, which is also a record. It's up 3% year on year. Average bond size is 1.3 million, also a record, never seen before in the property market. And so, all the indicators are positive. First-time buyers, 60% of the market of all applications is first-time home buyers. If you recall, Neil, a year or two, it was about 50%, so it's up 10%. Not a lot of movement this year, to be honest with you, but nevertheless, we have seen movement. Approval ratio from the banks, which is really, really important, 78% of all home loan applications are approved, which which illustrates the fact that the banks are absolutely wanting to lend. They have not adjusted their credit scores. So that's really important for the consumer to understand, that the banks are absolutely willing to lend, provided all your credit criteria meets their requirements. And then, I've been on a number of webinars and interviews of late, and everybody talks about the Western Cape, and I think rightfully so. The Western Cape has set the benchmark in terms of local governance and the way, the effectiveness that the DA has demonstrated or illustrated in the Western Cape in running a really, really tight ship and effective ship. But there are some interesting movements. Pretoria has seen a massive increase in the number of sales. From a home loan application perspective, we've seen a marked increase in Pretoria, and it stands to reason. There's big government employment there, obviously one of the biggest universities in the country. And I must say, we've just opened our new head office in Pretoria, in Hazelwood, and the infrastructure around Pretoria is not as bad as, in my opinion, not as bad as the Joburg CBD. The Pretoria CBD certainly needs some work, but the outlying areas within Pretoria are looking really, really positive. And so it makes sense that there's been this influx of home buyers into the Pretoria region. And I do think that there's been a sort of a mini semigration from Gauteng to Pretoria, or from Joburg to Pretoria. It's a nice leafy suburb and nice leafy area to live in. So we've seen some nice movement there. And then obviously the KZN North Coast continues to perform. Big developments going on there. As you know, Seaton is a hot topic in the KZN. The Collins brothers have built that, and then obviously there's a lot of other development in the North Coast, which is obviously all contributing to the increase in business there. So all in all, Neil, for once we can report really, really good numbers, really positive indicators. As I said, if the MPC sees fit to reduce the interest rate tomorrow, it will add further stimulus to the market. Stock problems are still an issue. If you talk to every single real estate agent, specifically in the Western Cape, and my wife is a real estate agent, she's forever moaning about the stock levels. But the truth of the matter is there is still a real slowdown in terms of stock, and that puts pressure on the market in itself. So we've seen some interesting stuff happening there, and prices being pushed up as a result, specifically in the Western Cape.
Excellent. Great. Thanks for that, Brad. I think a nice overview. Now let's look at the rental sector, Michelle, because I know your Q2 data has just come out, and so I'll be excited to hear some of the updates there. So over to you.
Thanks, Neil, and to my fellow panelists for setting up the market as it stands at the moment. And we'll talk about it in the subsector of the rental space. And I thought what I'd do, Neil, was I'd just share as a starting point. I mean, as property practitioners, we are collecting rent on behalf of landlords. So it's third-party money transactions that are happening. Of course, we've also got our own landlords who look after their own properties. But regardless of whether you've got a property practitioner or you're a landlord, I thought I'd talk about what the landlord's priorities are based on what our property practitioners are telling us, what they think their landlords' main metrics are that they need to service. The first one being place a quality tenant. This makes absolute sense. If we've got a quality tenant, we're going to collect the rent and we're going to get cash in the hands of the landlords quite quickly, because the second priority is fast rental payments. Landlords have, as Estiani and Brad have suggested, a bond that needs to be met. And so these property expenses, the cash coming through quite quickly is priority number 2. And then priority number 3 is preventing vacancies, because if we have a vacant property as a landlord, we're not collecting any rent, and that puts pressure on cash flow and on payment of expenses. So with those metrics, Neil, and with the metrics that you asked me to talk about today, I thought it correlates quite nicely. So let's run through some of those metrics and the data that we're actually seeing coming out of that. So the first one, given that we have an MPC meeting tomorrow, Brad, and that we're all hoping and praying for a reduction in interest rates. Not sure that we're going to be successful in those prayers this time around, but I thought what we would do is we would show what the interest rate increase, the stabilized, this is this blue line up at the top, and currently we're sitting on 10.5%, 75 at the time that we did this quarter two. We were sitting on 10.75% prime interest rate. We then looked at the inflation rate versus the rental growth. So you'll see that the inflation rate was back in 2022, it was sitting at over 6% above our target rate, and that red line coming all the way down to where we were in quarter two, 2.8% and 3% for that period. Rental escalation did the complete opposite coming out of COVID. And we saw the rental escalation growing from, in some instances, we were negative escalation, growing all the way up to just before this second quarter of the year. In quarter one of this year, we were at 6% rental escalation overall, which is incredibly positive news for landlords who had held back on escalations, and property expenses had run rampant. And rental escalations or rental growth hadn't quite kept up with it. So currently sitting in June of this year at 4.5%. How does that look as a quarter? Well, rental escalations or rental growth as a quarter was sitting at 5%. So still really, really pleasing. Down from its quarter one of 5.6%. As I said, I think in January there it was sitting at 6%. So 5.6 overall for quarter one, 5% overall for quarter two. Obviously, there's certain provinces that are outperforming and other provinces that aren't quite performing. Western Cape, as everyone's alluded to, a lot of immigration into the Western Cape out of Gauteng. And that's driven the prices up because there's a lot less stock. Not just from a sales perspective, as Brad has said, but also from a rental perspective as well. So we need to start seeing those developments supporting the migration that's coming into that area. Look, I just want to stop and have a general point here when we speak about migrations and people moving from immigration, people moving from Gauteng to the Western Cape as an example. When we look at, and I refer to the General Household Survey here as like an overview, when we look at rentals on their own, households that own rented accommodation, 48% of households that rent in Gauteng. So we still have a very, very large portion of the rentals in the Gauteng area. Second to that being the Western Cape, 13% and 12% in KwaZulu-Natal. So those three provinces really making up the bulk of households in rented accommodation in South Africa. So that's our rental growth. The next trend that we want to look at is, well, how quickly can I collect the rent, and can I collect the rent? We look here at both the willingness and the affordability of the tenant to pay the rent. Once the tenant's placed, we're looking at on the pay prop data to see how those tenants are paying their rent. So we're collecting through the pay prop platform 1.5 billion rands worth of rent on a monthly basis. And from that data, we can see how the tenants are invoiced, for what the tenants are invoiced, and how quickly they pay their rent, how quickly we can reconcile it and get it into the hands of the landlords or the property expenses on behalf of those landlords through the property practitioners. So what this slide tells us at the moment is that there has been, since we've been collecting the data, this has been the best month on record in terms of the number of tenants that are in arrears. So only 16.9% of tenants are in arrears. Be that, they haven't paid a full month's rent or they haven't paid part of the month's rent, only 16.9% of tenants have arrears at the end of the month. The value of the arrears is also the lowest it's been on record. So 73.7% of the rent value is in arrears on average. And look, there are different provinces that behave differently. Again, going to the Western Cape, where that's closer to only 50% of the value of the rent that's in arrears. Gauteng a little bit more than that. Western Cape only has 13% of their tenants that on arrears, whereas a province like Gauteng sitting at 15%, both of those below the national average. When you move into other provinces like Limpopo or the Northwest or Mpumalanga, you're closer to 20% of tenants that are still in arrears. So it very much is dependent on the quality of the tenant that you place in terms of the quality of the collection that you're going to get thereafter. We then wanted to look at the debt to income, rent to income, and disposable income, because this speaks directly to, in terms of our tenant placement, the affordability aspect is, can the tenant afford the rent? On average, through all the different categories of rentals, be it by the value of the rent or the province of where you rent from, on average, tenants spend around about 30% of their income towards rents. On average, our tenants are spending about 52% of their income on servicing of debt, on debt repayments, which leaves disposable income at 18%. But it does vary, so I don't want to leave us all thinking that's the average for everyone. It's not the older you get, for example, the less your debt to income is, as Estani was pointing out to us with your first time home buyers in your 30 to 40 or 40 to 50 range, more over indebted than our youngsters. I think only 6% of over 65-year-olds were getting bonds, which speaks to, again, the debt servicing levels of our consumers out there. So the lower the rent, in our more affordable low income, the higher the rent to income ratio, stretching even to 40% in some instances. And yet the higher the property value, the lower the rent to income ratio, dropping down to 20%. So again, what we're seeing is people with more income have more debt and a higher debt to income ratio, and that reduces their rent to income ratio or their ability to service their rent at a luxury properties, but with a high income. The last one that we wanted to talk about, Neil, was on deposit ratios. And here, on average, well, how do you prevent the risk of your property? What do you do to mitigate against the risk? And here we're seeing that the average deposit to rent ratio sits at about 130%. So if the rent is 10,000 Rand, the deposit that on average that our property practitioners are collecting on behalf of their landlords is 13,000 Rand. That's obviously to service any damages as well as any utility costs. And as we see the utility costs go up, we notice that deposit to rent ratio increases to service those increasing property expenses. Thank you.
Wonderful. Great. Thank you, Michelle. Thanks, Estiani, and thanks, Brad. So let's delve a little bit deeper, and also to our audience, please fire away with questions. We'll deal with it at the end. So Estiani, let's just look at the nodes, corridors that are driving gains. I mean, we've spoken about the immigration belts, and we also spoke a little bit about Limpopo. And so where is stock scarcity or service risk capping growth?
I think at the moment, just looking at the market, and both Brad and Michelle have actually touched on that. So we do seem to have quite a bit of a stock shortage in the Western Cape area at the moment. And, it's I don't think it's only the Western Cape. There's areas within even Gauteng at the moment as well, where the stock shortages, it becomes imminent, where owners are holding onto their properties a little bit longer to see, what's the market doing, and is there a price correction that's going to come, for them to actually capitalize a little bit more on their investment. So we do see that happening in Gauteng at the moment as well, but predominantly in the Western Cape where there's stock shortage.
Okay, excellent. So let's talk affordability and deposits, Brad. How have deposit sizes, ticket values, first-time home buyer share shifted? I know you touched a little bit on that. Maybe you can just elaborate. And where is affordability biting the hardest?
Yeah, so Neil, firstly, deposit ratios have come down from 20% to 8%. on average. So, I mean, that's a really good sign. Well, it's a positive sign from the consumer's perspective because they're not having to save 20%, which is a really, really difficult thing to do when you're in South Africa. So that's the first part. The second part is that we are seeing 100% and 105% bonds being approved by the banks. So that's zero deposit. That's actually taking care of your transfer fees, etc., and your costs when you're purchasing. So that's really really positive. I think the reality is affordability is always going to affect the middle market and the bottom end of the market more than anywhere else, and that's where you see high household debt ratios and a really tough environment to be able to save for either your costs or a deposit. So, yeah, those are the sectors that are certainly being affected more than any other.
Excellent. So, Michelle, let's talk about vacancy, tenant quality. Where are vacancies rising? I know you did share some, and falling by price band.
So Neil, I think when we look at price bands, different provinces sit in different price brackets. For example, areas like the Northwest and the Free State, the average or the peak of rental sits between 2,500 and 5,000 rand per month. And when you look at areas like Gauteng and KwaZulu-Natal, for example, we're shifting up into the higher brackets, so closer to the 7,000 to 10,000 rand per bracket. So it very much is dependent on the area and the income of those individuals within that area, within that environment. I think what we're seeing at the moment is in the Western Cape, enormous amount of pressure on stock availability from a tenant perspective, both because of the migration and, of course, because of short-term rentals putting pressure on the long-term rental market. A lot of development starting to pick up. I mean, Brad, you speak about Tshwane. I'm a happy new Pretorian myself, having moved there recently, just around the corner from you, and of course driven by children who change schools. But coming out of, for example, the Midrand area, there's an enormous amount of development happening in the Midrand area, not just in the halfway house side, but we're broaching over into the Diepsloot side. So a lot of formal housing happening around the informal markets at the moment, and that's good because we have an enormous informal market that we need to shift into formal housing, and I think that really is where the drive is. Not just at the top, at the luxury in the market. Estonia, I loved your graph speaking to the volumes in the different areas as well as the value in the different area. And I think that there needs to be and is a drive on that lower market to affordable market segment.
Yeah, and I think it's also linked to obviously employment stats as well, where the employment stats are up and down, and where there's certainly more activity over there. But thanks for sharing there. Let's talk about the price band dynamics, Estiani. What's happening in a sub-million, 1 to 2 million market and 2 I mean, I know you did show us some nice slides there, but where are you seeing from agents where listing discounts are more deepest and demand to stock highest? And I know we probably need, Brad would actually have an opinion on that. You would actually know. For certainly we need an estate agent in the room as well. Your thoughts here, Estiani?
Yeah, no, look, I mean, that's certainly obviously where, the majority of the activities are. And I think it also speaks to both affordability that, within that market, so sub-million, but also to the cost of acquiring real estate in that bracket. So, I mean, below 1.2, you don't pay certain fees. And I think that certainly helps in terms of the affordability and obviously the ability to acquire real estate. And we've seen in the graphs also, there's a big chunk of our younger generation or younger purchasers, almost up to the 50-year mark, where there is quite a bit of, or a big chunk that still is dependent on financing. for those properties. So obviously the cost will definitely make a difference or provide an influence, and then obviously the availability of properties in that sector, which there's majority of properties in that market. So yeah, I think that definitely speaks to the drive towards purchasing in that area, but also then again the availability of properties in that market or in that market segment.
Okay, thanks for that. So, Brad, just talking about bank appetite spreads. I mean, how wide are risk-based spreads across different segments? Like, for example, you mentioned the first-time home buyers, and obviously there's the investor sector, and then of course we get the self-employed. And I mean, is there any shift in 100% bonds or term flexibility? I know there's 30-year bonds, and you mentioned deposits have come down. Maybe just update us in terms of bank appetite of what's going on in those different segments.
Sure, Neil. So firstly, I mean, as I mentioned, deposit requirements percentages have come down from 20% at a high, and that was really when the interest rate cycle had sat for a number of months. Abnormally long period that we battled with. We battled through a high interest rate cycle at 11.75%. And again, I just want to touch on that for a second. People always they have this really bad habit of comparing the interest rate to 10 years ago or 12 years ago. And the cost of living was totally different then. The cost of fuel, your basic foodstuffs, fuel, etc., was much lower. So you're not comparing apples with apples. You've got to deal with the interest rate. You've got to consider the interest rate in the current environment. So again, I'm going to repeat what I said earlier on. The fact that we came out of the COVID years at 7.5% and had a 67% increase to 11.75 has had a significant effect on affordability across all price bands. So, to your question, what's the bank appetite like? The bank appetite is strong and has never wavered, actually. Our banking systems are very, very strong, very rigid, very well governed. And so the bank's appetite is good. Affordability is an issue, and affordability, as Estiani said, it'll always affect the lower end of the market. Unfortunately, that's the sector of the market that needs the most amount of assistance. So when you talk about deposits and 100% or 105% terms, yes, terms can be negotiated, and yes, we have seen 30-year terms. I will say that it's the exception rather than the rule. 20 years is still the basis on which most home loans are granted. And then 100 and 105% is certainly something that the banks are looking at and considering. I would hesitate to say that it is not the norm, and it's not something that we're seeing a lot of. We, as I said, deposit ratios are sitting at requirements are sitting at 8%. So, look, 8% is still better than what we've experienced in the past. I think it's positive. I think the banks are looking at any which way they can to assist. As you know, Neil, and the panelists know, and maybe some of the people participating in the webinar know that the banks themselves have targets in certain price bands, and they've got to meet those. So they do everything that they can to assist. Where are we seeing the most action? Everything below 3 million is still the busy price band for us. As I said, average purchase price is 1.6 million. Who would have thought, right? You go back 20 years and tell people the average purchase price was 1.6 million, they would have laughed at you. So, and we still see the average age of the first-time home buyer is still sitting at 37 years old. So that is still an issue, and that speaks to affordability and the need to save, and it takes you much longer to save for that first property that you're going to purchase. So we're hoping to see some reduction in those numbers, and that will obviously point towards affordability and also your household debt ratios.
You seeing more female buyers?
Yeah, interestingly, that's a good point, Neil. I think you and I had a discussion about this the other night when we had a function. 58% of our applications are female buyers. The ratio of male to female is 51%. What we don't see, obviously, is the cash buyers. So I think one has to just clarify that that's bondable business, not the whole market. But it's very, very interesting to see. And when we say female buyers, I think one must also define that, because I think that's a sole purchaser as opposed to a husband and wife. So that's really, really interesting to see. But yeah, equality brings that, which is fantastic.
Okay, great. So, Michelle, just talking about yields and escalations. I know you're an investor. We're also in an inflationary environment. Everything's going up. Rates are going up. Rentals are going up. It is going up, even despite the saying it's right about 4%. But so, I mean, how does it stack up after escalations? I mean, and maybe, with your sort of wearing your investor hat, you'll say which segments are cash flow positive versus margin squeezed.
So Neil, the beauty of rentals is that you buy a property, you get a rental price, and you've got an escalation as a result of that. So what is your annual return? What is your annual rental income divided by the market value, and that's going to give you your gross yield. Simple numbers will say that if I can get 1% of my market value as rent, in other words, I've got a 300,000 rand property, I get 3,000 rand rent per month. That's 1%. Times that over 12 months, I'm going to get a 12% yield on the property. That's a nice starting. I always like to start there. That's a nice starting place. The thing is, if you've got a 12 million rand property, you're not getting 120,000 rand rent per month. And so all of a sudden your yields start to come down. So if your gross yield is coming down, your net yield is coming down as well. So where you're going to get your better yields, well, it's going to be in the lower prices, in the lower end of the market. The higher the rent, the higher the market value of the property goes up, the less likely you are to get your 1% rent of market value, and your yields start coming down as a result of that. So your starting point for me is, can I achieve 1% rent of market value? And if I can, where am I going to get that? What value of rent band am I going to get it? And remember, at the very low end of the market, well, I've got tenant risk to battle with. Also, I'm going to have to get 10 units to manage instead of 1 unit. So I've got a bit of a concentration unit with one unit, but I've got a good quality, high income tenant over there. So your risk has to come in line with what you're looking to do as well. Low end of the market, you're going to get high risk, high reward. High end of the market, more luxury properties. Your yields are not as strong and not as good as well.
Okay, cool. So Desiani, I'm going to ask you a tough question, a 12-month scenario for valuations. You've got to feel that what you presented, give us maybe your base, upside, downside for values, looking in, 12-month scenarios. What single catalyst do you think, could flip your outlook? I mean, what is the measuring point that you think could change it, and what would invalidate that?
So it's a loaded question, Neil, but I think if we look at what's been happening for the first half of this year only or alone, in 2024, December 2024, we actually ended on quite a low point in terms of the value growth for real estate on an annual national level. So, we've grown. So let's just recap that. So at the end of 2024, we ended on about 2% in terms of just over 2% in terms of inflation for real estate, meaning the growth was quite low. We're halfway through this year and we're already sitting above 4%, almost heading towards 5%, and it's increasing month on month. So I think I personally am very positive in terms of the value of real estate, towards the end of this year and obviously into 2026. I think, even if we look at what's been happening on a political sphere, there's been a lot of stability, a lot more stability than we had in 2024. Yes, there's challenges, and I think we can't deny that. But we've had our interest rate decreases. We've had certain economic indicators such as inflation rate altogether that's been kept low, which I think will definitely help us to obtain that growth trajectory that we currently have up until, at least for the foreseeable few months ahead, up until, let's say, the end or mid of 2026. So I'm very positive in terms of the market itself. I think there's a lot of property still being developed all over the country, not only in certain areas. It's literally all over the country. I've actually had a look at some of those numbers this morning, where we could see that in the last 5 years, there was about 1,500 new estates you brought on, into the market, and almost 4,000 sectional schemes. So I think the market is still there's appetite. There's still a lot of development happening, and as Brad has mentioned, there's access to purchases, which again drives the demand for property. So yeah, I'm very positive and hoping to see that trajectory keep on increasing for the next 12 months.
Absolutely, with interest rates also coming down as well. So Brad, there's a lot of people listening here. They want to, apply for a loan, and over 70 odd people here we got today. So and I think let's talk about deal structuring that passes credit, because you're dealing with all the banks. I mean, what turns a borderline deal into an approval? Let's talk loan to value tweaks, the terms, the debt to income cleanup that needs to be done, rate buy down. Maybe share a quick, before and after to get applicants across the line.
Yeah, Neil, I mean, I think the biggest mistake, and I'm going to talk sort of high level as opposed to getting into actual numbers or for per deal, but I think the most important thing here is for people to understand what they can afford, and unfortunately, the market is saturated with affordability calculators, and those affordability calculators really don't tell you anything. You plug in your monthly earnings or your annual earnings, and you plug in what you think is your liabilities or your debt or whatever you need to pay back, or your cars or your house or your household debt, etc. And unfortunately, the consumer misses many points. So I think, without necessarily punting better bond, but rather just talking overall, I think it's hugely important to be pre-approved. And when you get pre-approved, you get pre-approved properly. So you go through a proper home loan process where we consider everything. And then you are able to and I said this on Espresso the other day, you have a license to purchase. And there are a whole lot of hurdles and pitfalls and things that people just, as a consumer, you just know nothing about. And interestingly, we've just started concentrating on the 3 million plus price bracket. So I know that it's quite broad, but we could narrow it down to the 3.3 to 7 million price bracket. And interestingly, the home buyers in that price bracket really didn't know much more than the people below that price bracket. So it just goes to show the level of education or the understanding rather around the process of home loans. In terms of rates and banks and what different banks are offering, I mean, as you know, we're a consumer champion, so we broker that home loan deal to 4 or 5 different banks, and the banks are hugely competitive, and that's the role we play. We're much like an insurance broker who takes your insurance to a number of brokerages and brings you back a deal that suits you. We do the same with the home loans, and I think it's just really important for people to understand that, because to get into the actual detail now around, I mean, I could give you examples of rate reductions. On average, a bond originator better bond will achieve 0.65 less than your own bank will give you. So on your interest rate. So if you get prime less 1, we'll get prime less 1.65. Now, that doesn't sound like much, but on a 1.5 million rand bond, that's 157,000 rand over the term of 20 years. And that, when you talk affordability and what makes or breaks a deal, on your monthly installments, that could make or break your deal. Literally, that could mean that you could afford the home or not. And those are the little intricate details that one has to understand. You've got to fight for the best interest rate. Unfortunately, in South Africa, and I've said this to you before, Neil, you and I have had a discussion about it. In the UK, there are 65 different products. There's interest-free, there's capital, whatever. There are a multitude of different products and permutations, etc. In South Africa, we have term and interest rate. That is it. It can't be more simple. And so you've got to fight for the best interest rate that you can possibly get. And the only way you're going to do that is to employ the services of a bond originator who will fight for you to get the best interest rate possible. So lots of concessions. The banks are willing to fight for the business. They're willing to provide great concessions on interest rates. But one has to go about it in an orderly fashion, and one has to present your case and motivate your case to the banks in a way that they want to see it. And for the average consumer, they will have no idea how to do that, and I mean that with with no disrespect intended. It's just the way it is.
And of course, the biggest benefit of coming to you as a mortgage originator is that you deal with all the banks. But if somebody wants to deal with a bank, and they don't get approved, then they need to go to somewhere else. Whereas all the data and information that is supplied is centralized with you. So maybe you can that's a big benefit, I think, for any sort of buyer, investor out there.
And I think, Neil, sorry to interrupt you, but I think it's even more relevant for the lower end of the market, the entry-level home buyer, because the entry-level home buyer will go to his bank and say, I want to purchase a home. They'll do a home loan application and it'll get declined. And 9 out of 10 times he gets declined for a misdemeanor, if want of a better term. But it's a misdemeanor in the big scheme of things. And that entry-level home buyer will never go back to the bank again, which is a really sad situation. We want to try and avoid that. We want to nurture that home buyer and get him rehabilitated as quickly as possible, him or her rehabilitated, and then put them back into the market. And that way, I think we'll see some much more positive movement.
Okay, great. Conscious of time, I want to deal with some of the questions here. One has come through for Brad and Michelle. Many administered prices, such as municipal rates, electricity and water, are generally increasing at above CPI inflation levels. What impact are these cost increases having on bond approvals and on residential rentals? And I was actually going to ask you for a 90-day operator playbook, Michelle, for property, and on, whether, in fact, the property managers actually pass the levy utility hike test. Because we're seeing a lot of homeowners associations and also a lot of sectional title companies who are also in massive arrears. So do you want to maybe give that one a crack first from a rental perspective?
Enormous impact, Jeremy. I can just respond with it's an enormous impact. So what has happened in the last 7 or 8 years is, as these utility costs, administrative costs have been increasing at way above, in some instances, double-digit territory. In some instances, it's put pressure on the amount of rental growth that we've seen. And you can see it in the rental growth prices that I showed there on slide 1. We were in negative territory back in 2020. So when you've got negative price escalation, driven, yes, by a pandemic at the time, but also driven by all these other charges that are being levied against the tenants. And it's not just service charges. In the past, Neil, I can go back to the 1990s, and that's how old I am, where the only additional charge that a tenant would receive would be the electricity. It wasn't even water in those days. And then in 2008, when sectional title started receiving their own rates and taxes individually, we started seeing this individual increase in not just the levy, but the rates and taxes that homeowners were seeing, which had to then be passed on to the tenants as well. water in back in the 2000s wasn't metered, and so in a sectional title environment, the landlord would cover the cost in their levy costs, and you wouldn't see an individual line item for water. So as we've seen, lease agreements have changed over the years to incorporate what are the different line items that are being levied against the tenant. Unless it's in the lease, it cannot be passed on. One of the costs, for examples, is not just the water or the electricity or the sewage or the pick it up. What are the individual usage charges that we can pass on to the tenant? As our municipalities become creative with the type of charges that they charge the individual homeowners, each of those line items then gets passed on to the tenant. We see lease agreements now starting to state if there's been an increase in municipal charges in the actual rates and taxes. When it comes to the municipal charges, once every 5 years, your rates and taxes itself can sometimes double in price. Can the landlord then pass that cost onto the tenant? So where your basic rental charge can seem like it's remaining really, really low, the landlords are overcoming that by increasing the charges that they can recover their own expenses, as well as ensure certainty in the collector. Landlords and property practitioners, one may argue, are debt collectors for the administrative charges that need to be collected by the landlord.
Great, thanks for that, Michelle. So, Estiani, there's just a query on one of your graphs. It says, looking at your graph showing property value trends over the past 20 years, unless I'm misreading the graph, there appears to be a dramatic retreat in value growth around 2009. And the graph indicates that value growth in 2025 has not recovered to the pre-2009 period. Is that really a fair reflection of valuation trends overall, including in the Western Cape?
Absolutely. Yeah. So look, I mean, 2009 was, we all recall, that was when we had the financial crisis and crash. I don't know what we call it, absolute devastation. So yes, no, absolutely. We have not recovered in terms of any of the provinces, to where we were pre-2009. The reality is, in actual fact, that some of the provinces are struggling more than before, the bigger provinces. So we've seen specifically 2004, we've seen Gauteng and KwaZulu-Natal struggling quite a bit, more than even other provinces in terms of value growth. And there's always reasons for. I think we can all recall, specifically in the KZN region where we had those floods, as well as the looting in 2022-2023 period. So all of that impacted obviously on property prices and the increases in value there. So yeah, but all in all, we have not recovered. The market have not recovered to pre-2009 value increases. Although, just keeping in mind, this is a 25-year view. Obviously, there's a much longer view to acknowledge, and there's a nice indication that we've seen is, in the last 50 years, there's only been about 3 years where property value growth was negative for some period of time, or a year in those 50 years. So, yeah, just keeping in mind this is only a 25-year view, but it certainly is what it is at the moment.
Great. So thank you for that, Isiani. Okay, so Mikey asks, how do we lodge an objection to the market value of a property under the Ekurhuleni municipality? Well, I can't tell you about the Ekurhuleni municipality, Mikey, but I can tell you in the Cape Town municipality. I mean, I sat right next door to our deputy mayor, who shared his cell phone number and his email address with me. And so if you have a problem, you can go directly to the mayor. I'm not quite sure in Ekurhuleni. I'm not quite sure who heads it up over there and who will respond. I don't know if anybody's got any comments there. Estiani, I know you in Tshwane. Michelle, you're also in Tshwane now. And Brad is in Cape Town. So I don't know, what the process would be. And I would actually be so fearful. And I think this is the big problem that a lot of the municipal ratepayers are actually having in Johannesburg, is that they do not have access to, or even a line to the municipality when there is. I don't know. You want to comment, Estiani?
So, look, I mean, on the municipal valuations, there always is a period or a window for objections. So, as a homeowner, you should have received, your valuation, and then obviously the opportunity to object against those. For Ekurhuleni, if I'm not mistaken, the deadline was in June already. So, you had opportunity until then to object, but there's always supplementary roles being made available. So maybe just, I think as a guideline or as advice is to go and approach the municipality directly to see if there's opportunity to do an objection over and above the allocated time which they had made available for objections to be submitted.
Okay, great stuff. Thank you for that, Estiani. Dennis, I'm not going to put your question to to our panel because I'm going to ask them to do a quick wrap, but I'll respond quickly. It said, I found the KZN property values remain fairly low during the past few years due to infrastructure problems. Is there any positive change envisaged in the foreseeable future for parts of KZN? So, Dennis, I think it's very difficult to say, but I think all markets will bounce back. That's what I would say. And I think Brad he actually was talking about there's certain areas in KZN, certainly from, Mhlanga to Belito and even north of Belito now, those areas are certainly in demand. And will it change? Yeah, it's a kind of, who has the crystal ball? Markets always definitely bounce back, and we hope that municipalities will bounce back in line with markets. But certainly, I think over a longer term basis, definitely. And while prices are good, maybe it's a good time to get in. But don't tell you, I'm not telling you that. You're going to have to go do your own homework. So, in closing, can you believe it? We've come to our end. So, what I'm going to ask to do is to ask each one of our panelists just to give their final wrap. Just your final, give like your 1 minute thoughts of to the audience that they can maybe take away and use, whether in terms of, your particular service you're offering or something that they could really take away and say, wow, that was really good. Estiani?
Thank you, Neil. Awesome. It was an awesome discussion. And yeah, I think it's, as you've mentioned just now, markets do always bounce back. And I think it's, it's everybody's responsibility to play their part therein. And if you are in the market to purchase property, and if you are in the market to be a property investor, do your homework, understand the market, understand the areas. And there certainly always will be pockets of areas that are doing very well in terms of property investment. So yeah, I think we've got the tools. Let's use it to help us make those informed decisions. And I'm positive about, obviously, majority of the areas and the future of real estate. I guess I'll always be.
Great. That's awesome. Great. That's Estiani Marks, who's Business Development Director of Lightstone. Okay, so next, Brad, your final thoughts, your parting shots to the audience over there.
Thanks, Neil, and thanks for the discussion today. It's been great. I think the most important thing is to understand your affordability as a home buyer, to look outside of the areas that you ordinarily would have looked at. I think there's great value in areas outside of the Cape Towns and the Joburgs, etc. We've seen some nice uptake in the rural areas, so-called rural areas. Commuting is a part of our lives, so I think one has to consider that. And I think, to Michelle's point, really, really important to understand what your rates and taxes look like in your respective area that you want to purchase. It's something that can make or break your deal, and it certainly affects your affordability. And so, and then last but not least, make sure that you, to Estiani's point, do your homework. Be really, really diligent in terms of understanding what you can afford and where you're going to purchase, and equally what that area is doing in terms of property growth, etc. And I wish the home buyers all the best.
Fantastic. That's Brad Brendel. He is the head of sales for Better Bond. Okay, and last but not least, Michelle, your final thoughts, parting shots to the audience.
Well, Neil, I'm going to wear my pay prop hat, and I'm going to talk about cash. Cash is king, and the flow of funds. It's vitally important that the rent, all those additional line items that need to be passed on to the tenants are properly calculated, properly put on an invoice, properly sent early to the tenant, so that the tenant, when their salaries land in their bank accounts, the first thing they think about is paying the invoice that's already in their inbox for their rent, and we're not leaving those invoices until the first of the month to send. because by that stage, the tenant's paid your rent on all sorts of other things. It's 30% of their income. So really using your prop tech, getting the rent collected as quickly as possible and getting it into your landlords will keep that cash flow and the flow of funds circulating nicely.
Awesome. That's Michelle Dickens. She's Commercial Director of PayProp, Repit. And once again, I want to thank all our panelists today. Thank you very much for your valuable insights to our audience. Thank you for joining us live, and thank you for your interaction. There will be a replay link that will be sent shortly. Don't miss our next webinar. There's no webinar next week because next Wednesday we have a public holiday. So no webinar on Thursday or Wednesday. We are coming back in 2 weeks' time because REI is going to be at SAPOA the week after. So the SAPOA event and the awards is going to be at Sun City, which I'll be attending. So there is one which is on Thursday, the 9th of October. Future-proof property certification, performance, and green finance. And we know that it's no longer optional. Learn how to protect values, secure capital, meet ESG targets while avoiding costly brown discounts. So we find out more about that. There is a link below, or just go to the rei.co.za. So thank you very much for joining us. Always wonderful. We'll see you in 2 weeks' time. So once again, I want to thank our panel. Wonderful. Estiani, Michelle, and of course, Brad, thank you for joining us. I think it was a great discussion. And so thank you again. And this is Neil Peterson, our real estate investor, signing off. Until next time, stay informed and keep investing smart.